In a recent interview with the BBC, Larry Fink indicated that the global economy faces a stark and steep recession if oil prices rise to $150 a barrel due to the ongoing geopolitical tension in the Middle East. Today, with so many pundits and talking heads pontificating on the direction and trajectory of the world's economy, I was tempted to ignore Mr. Fink's remark. However, Larry Fink is no ordinary commentator. He is, after all, the CEO of BlackRock, the world's largest asset manager, managing over $14 trillion in assets. Recognizing who the author of the statement was and the position which he holds in the investment world, it got me to thinking, if a global financial shock would hit tomorrow, which Caribbean banks would stand firm and which would buckle? Having survived COVID and successfully navigated the 2008 financial crisis, are Caribbean banks prepared to take on the next black swan? In today's episode of our podcast, we'll be examining a question that sits at the very heart of financial stability in the region. How resilient are Caribbean indigenous banks? With capital adequacy and liquidity ratios significantly in excess of statutory requirements, and with the efficiency ratios for the most part in the low 60s, the Caribbean banking system is often described as conservative, well-capitalized, and stable. However, beneath that facade of stability lies a more complex reality. For openers, these banks operate in small open economies. These economies, for the most part, are highly import-dependent and consequently extremely vulnerable to external shocks. Today, we put the resilience of indigenous Caribbean banks to the test by examining 5 major risks that these banks would face with the current Middle East crisis to exacerbate, thereby triggering a global financial crisis. Against this background, the most immediate and obvious risk that indigenous Caribbean banks are likely to face is the risk emanating from an energy price shock. The Middle East conflict has already triggered major disruptions to global oil and LNG supplies, with up to 30% of oil flows affected in extreme scenarios. The invariable increase in oil and gas prices will act as a direct tax on Caribbean economies by both reducing disposable income as well as suppressing effective demand. The net and inevitable effect of these transmission mechanisms will be rising inflation and a higher cost of living, leading to an increase in household distress, resulting in increasing levels of non-performing loans in the areas of consumer lending, mortgages, and the SME sectors. Sectors which were already weakened during the COVID pandemic when regional banks were forced to take significant write-downs on their loan portfolios. For indigenous Caribbean banks, the energy price shock and its direct impact on inflation and disposable income is arguably the number one balance sheet risk of the current geopolitical environment. In a scenario where interest rates have already been rising and are currently elevated, and in an environment in which the IMF is warning of slower growth and persistent inflation pressures, the current conflict in the Middle East will not bring any relief to customers who are hoping for a rate cut and an overall reduction in borrowing costs. More than likely, the current conflict will lead to increased borrowing costs in the region as the Federal Reserve in the United States eyes increases in the Fed fund rate. Indeed, we are already seeing this in real time with the recent sharp and upward moves in US Treasury yields. With funding costs at Caribbean banks remaining elevated for longer, demand for loans is likely to soften, especially in the areas of mortgages and for business expansion. In addition to its direct impact on the funding costs of its customers and the suppression of loan demand, the anticipated increase in interest rates will also have a direct and negative impact on the bond portfolios of indigenous Caribbean banks. Most, if not all, Caribbean banks carry a large investment portfolio on their balance sheets. These portfolios typically comprise of fixed income securities and government bonds. With the increase anticipated in interest rates, these investment portfolios will undoubtedly suffer significant mark-to-market losses, which will invariably weaken their balance sheets through the erosion of capital buffers. The situation can be further exacerbated in the event that the bank deposits reprice faster than the assets, thereby putting additional pressure on the bank's net interest margins. In a nutshell, while higher interest rates may boost interest income for banks, they also reduce loan demand, increase external funding costs, and bring increasing pressure to borrowers who may be already struggling to pay their loans. Another way in which Caribbean banks will be affected if the Mideast crisis did lead to a global financial crisis would be through external sector pressure and foreign exchange liquidity risk. As I've indicated previously, most Caribbean economies are small, open, and import dependent. They are invariably net importers of energy and food, whilst also being dependent on tourism and external inflows. In other words, access to foreign exchange is a key driver of economic growth. The flip side of this is that the unavailability of foreign exchange can be a significant constraint. The conflict in the Middle East is already causing rising import bills, particularly in the areas of energy, fertilizers, and food, and at the same time will more than likely lead to a slowing down in tourism due to the higher travel costs and security concerns surrounding the geopolitical environment. In terms of the direct impact which these events or actions would have on the banking sector, there will be an increase in demand for foreign exchange in order to compensate and pay for the higher price imports. This would happen, interestingly enough, at the very same time that there is a reduced availability of foreign exchange in the banking system. This creates a squeeze, more demand for US dollars at the very point where the supply has been significantly reduced. For indigenous banks, this would mean difficulty in meeting clients' demand for foreign exchange, a strain on international settlements, and invariably an increase in reliance on correspondent banking lines. Another way in which regional banks will be affected would be as a result of the interconnected nature of the global financial system. If tensions escalate in the Middle East, investors will become more risk averse, and there's every likelihood that capital flows will shift towards safe havens, leaving emerging markets, including the Caribbean, holding the proverbial bag. For Caribbean banks, this would mean operating in an environment where liquidity becomes less predictable and funding gets even more expensive. Perhaps the most significant risk which Caribbean banks would face in the event of a global financial crisis would be the risk of de-risking. Given the small and underdeveloped state of regional capital markets, along with the openness and import dependence of the underlying economies, access to the global financial system is critical for Caribbean growth and for the resilience of Caribbean banks. This access depends on correspondent banking, a medium that governments and financial institutions utilize to facilitate trade, investments, remittances, and credit card settlements. However, in times of global uncertainty, large international banks, particularly those operating in the United States and Europe, tend to become more cautious and may even withdraw from providing these traditional services to the Caribbean. And this is exactly what happened several years ago. Starting in 2014, most Caribbean banks saw a steady decline in correspondent banking relationships with large international banks such as Citibank, Bank of America, Bank of New York, and Wells Fargo, deeming the region either too small or too risky to be profitable due to the higher compliance costs of maintaining a relationship with banks in these jurisdictions. This process, which became known as de-risking, meant that key Caribbean sectors such as tourism, trade finance, credit card settlements, remittances, and foreign direct investment were severely handicapped. While the correspondent banking issue and the de-risking phenomenon has since improved, there is still a reticence on the part of some international banks in returning to the region. With the increasing geopolitical tension in the Middle East and the economic uncertainty which it has brought about, there's every expectation that AML compliance issues and issues surrounding terrorist financing will invariably re-emerge. These are the very same issues which led to the initial round of de-risking in 2014. This will no doubt lead to enhanced compliance and due diligence standards, with an inevitable increase in risk aversion among US and European banks to doing business in the region. Without a doubt, and at the very least, this would lead to renewed de-risking pressures, higher compliance costs, slower cross-border payments, and trade finance constraints. So let's see if we can summarize all that we have said before. While the Caribbean and indigenous Caribbean banks may not be directly exposed to the current geopolitical tensions currently affecting the Middle East, the conflict may nonetheless act as a stress amplifier to pre-existing underlying vulnerabilities, namely the region's openness, its import dependence, along with its shallow capital markets, and a financial system dependent on external finance and especially correspondent banking. Something to think about. A word to the wise.